Nvidia says we're on the edge of a new industrial revolution, with $3 to $4 trillion in AI infrastructure spending by 2030. That's more than the entire GDP of Britain. But here's the twist. A shocking 95% of companies report zero return on their AI pilots. So are we building the foundations of the future, or a trillion-dollar illusion? This isn't anti-AI, it's about the gap between spending and results. We'll track the money from Nvidia's chips, to hyperscaler data centers, to corporate profits, to jobs. And at the end, I'll give you a simple investor framework to separate winners from hype. Nvidia just posted $46.7 billion in revenue last quarter, up 56% year over year. Data center sales alone, a record $41 billion. CEO Jensen Huang calls this an industrial revolution, projecting $4 trillion in AI infrastructure spending by 2030. To put that into context, $4 trillion is more than the economies of Canada and Brazil combined. Imagine rebuilding the energy grid of a continent just to power algorithms. Take OpenAI and Oracle's Stargate project, over 5 gigawatts of AI data centers in the US, packed with more than 2 million chips. Projects on this scale change the maps of power and capital, and the money is already moving. Fast. But here's the catch. Outside big tech, adoption is shaky. A MIT Media Lab study says 95% of AI pilots create no measurable return. Only 5% produce millions in value. Another survey by S&P Global found 42% of companies abandoned AI projects last year, up from just 17% before. Case in point, a Fortune 500 insurer spent millions on AI claims processing. After errors and customer backlash, regulators stepped in. 6 months later, the project was scrapped. Infrastructure is scaling, but organizational learning is lagging far behind. Organizations struggle to integrate AI into messy workflows, legacy systems, and regulation. The numbers suggest a yawning gap between CAPEX and realized productivity. Until companies close that gap, the infrastructure boom may outpace actual business value. Upstream, demand is strong. Taiwan Semiconductor, the world's top foundry, says customers aren't backing down. Orders stretch into 2026. That means hyperscalers are locked in, even if enterprises lag. Supply chain commitments and long lead times create a near-term guarantee for chip makers and data center builders. For investors, that means a multi-year revenue tail, while enterprise adoption catches up. What about jobs? The Economic Innovation Group found workers most exposed to AI outperformed others in the labor market. But Stanford researchers saw a 13% employment drop for early career workers in AI-heavy fields like junior coders and paralegals. Case study. In legal tech, AI cut document review hours for junior associates. Partners served more clients, but young lawyers lost opportunities. So far, AI isn't killing jobs outright, it's reshaping career pathways. Workers adapt, some win, some lose, and the net effect depends on policy, training, and time. The long run will be decided by who adapts fastest. Nvidia doesn't need to prove AI's ROI, they win when hyperscalers buy chips. But for the rest of the economy, proof of productivity gains is still missing. Forward PE ratios for most sectors haven't budged. Industrials ticked up, but mostly thanks to building data centers, not using AI. Until ROI moves beyond big tech, this revolution remains unfinished. Think in 3 buckets. Bucket A, infrastructure winners now. Nvidia, TSMC, SK Hynix, Broadcom, liquid cooling firms. Bucket B, platform consolidators next. Microsoft Azure, Google Cloud, Oracle. They monetize inference at scale. Bucket C, applications later. Insurance, healthcare, logistics, support. But beware, nearly half of AI startups fail before scaling. .com had Cisco and Intel as infra winners, but true fortunes came when Amazon and Google proved ROI. History may rhyme here. Allocate with time horizons, short-term infra, medium cloud, long-term apps. Watch for verified ROI. The revolution becomes real when 3 things happen. 1. Verified case studies show margin lifts in non-tech sectors. 2. AI systems learn and improve in production. 3. Inference costs fall below enterprise switching costs. Until then, we live in a CAPEX boom, ROI lag. Nvidia is cashing in today. The question, will the rest of the economy catch up, or will AI spending turn into the next trillion-dollar bubble? Comment below, is AI the new electricity, or the new .com?